No doubt by now, you know that Trump has won the US election. And I'm not going to get into Trump versus Harris and who should have or who shouldn't. It's not the point of this video here today. If you're a homeowner, if you're an investor, if you want to look at Canadian real estate, at this point right now, this video is going to be important for you to watch because we're going to break down an understanding of the correlation of United States policies, historically speaking, and Canadian mortgage rates. Before I get too deep into this, I'm going to preface by saying by no means am I a 100% economic expert on all things related to Canada and US economics. But I did some research and I did some breaking down of the information, and I'm going to explain it to you as I understand it, and I'm going to interpret to you as it's noted so that you have something that you can follow and have a complete understanding of what this means for you. So I broke this down into a number of segments that I'll cover today. Basically 7 key factors or 7 considerations that you're going to want to know as it relates to your mortgage and what happened yesterday and how that'll impact you. There's a lot more data that's going to be coming out over the next couple of weeks and few weeks. So some of this information could evolve in regards to the specific numbers, but the concepts will still remain the same. But let's get into it right away. We want to start off first and foremost by talking about the correlation between the US and Canada as it relates to our economic linkage, the correlation between the two, which is basically the likelihood that one impacts the other. So I've got some information data, and I really want to start off with this. First and foremost, the question everyone's asking is, well, with Trump in power, what does this mean for mortgage interest rates? Let's start off with that correlation right away. Going back to 1991, correlation between the US and Canada on 5-year yields is basically 0.95 correlation, with 0.75 generally being considered a strong correlation. So it's extremely strong. So if we look at what's happening first and foremost, anything previously speaking as it relates to significant US bond yield movement has generally speaking anchored or brought up the Canadian yields, which obviously, as you know, has a significant impact on Canadian fixed rate mortgages. Even without any immediate policy action in Canada at this point right now, what's happening down there, quite frankly, will bring us up or bring us down. So let's talk a little bit about what the impact of the Trump proposed agenda is as it relates to Canadian mortgages. So first and foremost, Trump's administration, as you probably know, is expected to increase spending and maintain the large deficits, which are historically massive as it is. And if we look back in history, Republicans in Trump's previous 4 years in power, they pushed for fiscal or financial stimulus, which basically includes government spending and tax cuts. So if we look at the data points there, essentially what we're looking at here is the US deficit right now is already at an absolutely insane, astounding $1.8 trillion. Like that is mind-numbing, $1.8 trillion and rising by the second. If you haven't looked up that US debt clock, search that up on Google, US debt clock, and you'll see that just going up and up and up and up and up. It's actually crazy to look at. Spending right now is expected to grow by another 10.1% in 2024, which pushes up obviously borrowing needs and bond stimulation. Okay. If we look at it from this perspective, the deficit-driven spending is likely to put upwards pressure on the United States, obviously, the US Treasury in this case, which pushes up the US Treasury yields upwards. So this effect, based on the correlation, will basically push up Canadian yields because investors demand a similar return to Canadian bonds as US bonds. So basically, in short, this upwards pressure is going to push up the US Treasury, which in effect is going to push up the Canadian bond yields. And we've talked about this in the past, and we've had expert guests on the show in the past talking about the specific correlation between the Canadian 5-year bond yields, the 4-year swaps, and fixed rate mortgages. In English, essentially, if US Treasury goes up, so do Canadian bond yields. And that happened today, with the reaction basically being right now, almost immediate, as soon as the election notes came out. And even before that, as soon as there was positivity that Trump was going to be elected, the bond market started reacting in that sense almost virtually immediately, which brings us to the next point, the Canadian bond yield reaction right now. As the US Treasuries rise, as I mentioned, the Canadian bond yields often follow. The 5-year bond yield as of this episode in this show right now had already risen 42 basis points since mid-September based on the assumption that these things were going to occur, which is not a little bit of money. Like 42 points is since mid-September September is almost 0.5%. And so you can almost kiss those 3.99% rates goodbye over the course of the next couple of weeks, especially if this holds the way it is right now in this upwards trajectory. So Canadian 4-year swap rates right now, which is a key measure when it comes to fixed interest rates, are also expected to rise by as much as 30 basis points. Again, this is going to put upwards pressure on fixed rates. So although we're not seeing a significant difference in the advertised rates in the marketplace right now, those deep discounts that the banks were offering will start to go by the wayside very quickly as they get repriced basically on a daily basis, which means, again, some of those discounts that you were seeing before are going to disappear pretty quickly. And we're already starting to see that with banks showing 0.1, 0.05, 0.15% increases in advertised rates, even as of today or the recording of this episode. Again, the US Treasury itself yield continued its trajectory up towards about 5%. Again, looking at these numbers right now, we have to note that this is like an instant reaction. We have US job numbers coming in pretty quickly right now, and a lot of these things could adjust with the US Fed decision. But for the sake of conversation, this is an upwards trajectory that is appearing to hold, and we'll see what happens. So what's the impact on you as a borrower? As we mentioned, like first and foremost, as fixed rates are partially impacted by bond yields, you're going to face potentially higher rates than what you saw before. And as a whole, and this is something we will talk about as the video goes on at this point right now, the trajectory itself can change and can evolve. In 30 days, it might evolve differently. But right now, the forward markets are pinning the fixed rates to basically be bottomed out over the course of the next 12 months right now, and actually have an upwards trajectory over the course of the last 5 years, which is very different from what we saw just a month and a half ago in September, where we were seeing the possibility of fixed rates all in the threes. And so obviously what's happening down there is going to cost Canadians more money, short and sweet. So where does this leave people as it relates to that whole like variable rate and fixed rate choices? So with rising bond yields, fixed rates right now might be more attractive today to provide the stability now long-term than it did before. Like the most common fixed rate mortgage in Canada right now has been the 3-year fixed. You might see more people choose to lock in for a longer timeline, like 5 years, with the fear of the possibility, especially with the forward markets projecting nearly up over the course of the next 12 months right now. You might say, screw it. Let's lock in right now at what I know, which is 4.25, 4.5% versus, a 3-year timeline, because I don't feel confident that anything is going to change in the next 4 years other than that upward stimulus in the rate environment. So if we're looking right now at that interest rate margin and someone's looking at it from a 3-year perspective or a 5-year perspective, and they're looking out based on where projected variable rates could go from the BOC, knowing that there's a different factors that impact that one, even though the variable rate right now is still winning on paper, there still is a difference, about $2,100 on a $300,000 mortgage over the course of the next 3 years. The forecasts are really uncertain. So I think what we're probably going to see, especially over the course of the next 30 to 90 days, is although some are going to continue to go variable, knowing that they're most likely to save money and they're comfortable, obviously, having a little bit of risk in their mortgage options, I think we're definitely going to see more people lean towards that fixed rate for that assurance, knowing that, okay, there is maybe a cost to doing this, but as long as that prepayment penalty consideration isn't a problem, as long as I'm not worried about paying those large penalties, and the reality is that fixed rate has an assurance in how much money I'm going to save over that period of time. Right? Let's talk a little bit about inflation concerns. And this goes pretty deep, and it's definitely over my head in some areas, but I want to talk about the notes that I pulled out here and some information that may impact you. So Trump's previous terms saw the US deficits rise very sharply, and he's expected to have a pretty similar approach this time around. The US debt to GDP ratio could exceed 100%, which basically is inflationary, which is going to lead to potential rate hikes as we look in the near term right now. BMO Economics recently pointed out that the US debt may become unsustainable if it reaches 175% of GDP, especially if there is a downturn. The fact is, a rising US inflation can drive up Canadian inflation as well, unfortunately. And given obviously the current high cross-border trade that we have right now with volumes and correlated consumer markets, like the impact is going to be basically direct from our perspective. Obviously, as you know, higher inflation reduces our purchasing power and our borrowing power, which is something that we've almost been dealing with. We've been dealing with it perpetually over the course of the last year with our dollar being at record lows. Basically, it's going to impact everyone at home with everything as it relates to purchasing power and spending. So ultimately, this could impact us in so many different ways, notwithstanding the fact that everything in our lives is about to get more expensive with this information. As it relates to the impact on inflation and rates, the BOC typically cuts rates during economic slowdowns, as we know, and Canada is not in a great position right now, but the inflation could keep rates higher for longer or force potential rate hikes. Now, the chances of a rate hike happening in this cycle are very limited, and Canada is definitely still in the deep end as it relates to our economic situation right now. But the reality is what's happening down there could force our hand and make us hold rates higher so as not to completely separate the two economies. Obviously, there's a lot of data, a lot of information to say what's going to happen and how that's going to impact. And we've yet to hear anything yet. Well, it's only been a day or two, and we won't hear anything for the near term as far as how our government may react or how our bank may react to what's happening in the United States. But this is all possible given the information. Now, since 1991, as I mentioned, correlation between US inflation and Canadian inflation has been 0.82, which is significant. It's very significant. Significant enough that a US inflation uptick basically drives our inflation upwards, as I mentioned. Now, a couple notes on this. Trump's previous trade policies included protectionist tariffs on Canadian imports. So he was adding taxes on Canadian imports. Not good, right? And this hurts our economy, and it hurts our exporters through obviously higher costs, and ultimately, as you know, not good for businesses to see that sort of thing happen, reduces the amount of business in our end. Now, the new tariffs could further obviously exacerbate that and hurt our economic growth as a country. So just so much to take away from all this information. Now, let's talk a little bit about the rising bond yields, okay? So first and foremost, now this is something where I'm going to have somebody come on in the future, and we're going to talk about this in a video, get into the concept of bond vigilantes. So I've broken this down as best I can to explain it. So we have what we call bond vigilantes, and these are investors who are going to sell off bonds rapidly when they fear any type of fiscal irresponsibility, which basically causes bond yields to drop and yields to spike. Not good. Historical example that we would look at is in 2022 when the UK unveiled a fiscally irresponsible mini budget. The bond vigilantes pushed the UK's 5-year bond yield up 112 basis points at 1.12% in just a few days. So why this is important based on the research that I did is that if the US deficits balloon, if they go up under Trump without a clear plan to how they're going to get rid of all this debt, the US vigilantes could push yields up, okay, which basically impacts Canadian rates indirectly, which obviously brings our bond yields up at the same time, therefore making mortgages more expensive. So that's kind of how that works. I hope I broke that down as clear as possible for you. Now, there is something that they're calling the Canadian safe haven effect, which is basically where US bond yields rise dramatically. If they rise dramatically, Canada's AAA rating could attract international investors, which basically they're temporarily lowering our yields, which would help us obviously keep rates a little bit on the lower side. However, Canadian yields often realign with the US, reaffirming that correlation between the two. Not good. So basically, this whole safe haven possibility, it could be short-lived, and our ability to keep our yields low would be negatively impacted over the long term. So it would go right back up, but there is a possibility that could help us out in the short term. What does this really mean as it relates to the long-term effects and the possibility of a recession? Number one, if there's a potential US-led recession, okay, the recession trigger is rising deficits and inflation could lead to a slowdown in the US, which we could see happen. Desjardins Economics suggests that a Republican sweep, which is what we're seeing right now under Trump, may pull the Canadian GDP down by up to 2.4% over the next couple of years. So with Canada's economy so connected to the US economy, a US-led recession could reduce the demand for Canadian exports and slow our economic growth down dramatically, which obviously is negatively impactful for the overall market. So our country has to provide more stimulus, right? In doing so, obviously it impacts job growth, job stability, and particularly could impact real estate demand. On the flip side to that is, let's talk about demand. If US enters a recession, Canadian consumers may become more cautious. And obviously not having jobs is a good reason to be cautious in the marketplace, which is going to lower our demand and, of course, potentially cool off the housing market. Again, these are all conjectures and considerations, but things that we should look at nonetheless. Now, for example, after the US 2016 election, their policies slowed down the Canadian economic growth for a period of time, and it did see a cooling in the market in some segments. Again, this is something that could happen if a recession emerges, not likely, but possible. Although we've talked and had many conversations about the strength of the Canadian real estate economy, it's just a factor of consideration. So what are the key takeaways for Canadians as homeowners and borrowers? The advantage of fixed rate right now is in a time of volatility and potentially taking rising rates, fixed rates are going to offer a lot more security for mortgage borrowers. So on a $300,000 mortgage, fixed rates could protect you from unexpected hikes. It could protect you and save you money if rates don't come down and if fixed rates decide to spike over the next couple of years, that 0.3 or 0.4%. So someone jumping in today, lock in a low rate, make sure that you are careful with those prepayment penalties and you can be protected. What I would suggest to that is that Canadians should be paying attention to information like this as it relates to trends. And if someone is coming up for renewal in the next 12 months, it may push them to consider the possibility of locking in now with the understanding. As an example, we have some strategies where we could lock in someone now who's maybe 12 months away. And if rates do react negatively and they start to go back up, we could choose to break that with a 3-month interest penalty, therefore saving them money over the long run. So I do believe that Canadians should be reaching out earlier than later as it relates to fixed rate mortgages, if that's what they want to go with, potentially going up in the near and the long term if the market reacts that way. Overall, should someone go fixed or variable? I guess it depends on their views and their opinion. We can't really foresee that far ahead. There's just way too much data, way too much information, and this is something that just suddenly happened. But my suggestion is based on all the data, all the information. I've been reading this for hours today to go through as much as I can. The forecast curve right now for fixed rates is not on the positive side, where there was an impact immediately. And yes, we do know that the BOC is likely to continue lowering rates and the market still projects out at 1%, lower than today. But overall, if someone is uncertain and uncomfortable with basically the market itself continuing to evolve in a way that they're not sure about, basically reality is they should consider a fixed rate and just be careful with what kind of prepayment terms you have and what types of prepayment penalties you have, because those are the ones that are going to kill you in the long run. So overall, like just to summarize some closing thoughts right here, as long as you're still with me, because this is a lot of data and information, basically the US policy changes that we're going to see or what we're going to see, specifically the higher yields and potential inflation, can impact Canadian mortgages and ultimately our affordability as a nation. My suggestion is consider whether or not you feel prepared for these potential implications. Like consider, like, do I feel like prepared to overcome this? Am I coming up in the next 6 months? Do I have a plan to overcome this? What does this look like? And if they're concerned about the potential of rates going higher with this happening, I would recommend leave a comment below or send me a note. You can find me on Instagram at The Mortgage Pug or at Flow Mortgage Co. And we can talk a little bit more about how we're looking at these strategies over the midterm or the long term. I don't want this to seem like a scare tactic that we're for sure going to see rates go up 75 basis points. But ultimately, as it stands right now, there's a lot of uncertainty after today. And really, as a talking point to this video, it just tells you that there's these projections and forward markets can be right in so many ways, but things like this can completely change and impact what you can do or what will happen as it relates to the marketplace. If you found value in this video, I'd love it if you give me a like or a thumbs up. If you disagree with anything I said, feel free to send me a note or leave a message. I'd love to hear some feedback. And if you feel like you're an absolute expert in the space and you're qualified to do so, send me a message. Happy to have you come on. Otherwise, we have a couple of great guests that'll be coming up in the next few weeks to talk about the impact of what just happened today on the real estate market. Thank you very much, guys, and we'll see you on the next one.